Good evening, ladies and gentlemen, and I hope all of you are well. Welcome to the second last webinar in this informative and educational mentorship series of webinars hosted by SADA. I see that our numbers are still going up now, so as we wait for the numbers to increase, I can perhaps mention the latest developments with regards to the dental assistance examination that I'm sure you are all aware of. The HPCSA recently announced that they will be providing two last opportunities for dental assisting practitioners who were registered under the grandfather clause to write the national board examinations and register as dental assistants. The examinations will only be held in November of this year and then March 2024. So we are urging all the dental assistants to please make use of this final opportunity to write the examination and obtain registration. And then to those members who are yet to activate the MyGlue account, please expect a call from either Bonolo or Mark. They have been recruited by SADA on a project basis to assist members. So they will take you step by step through the activation process, and this will only take approximately 3 minutes or so to complete. I think our numbers are steadily rising. We can maybe get started now. So tonight we have the pleasure of hosting Dr. Mansoor, who is an entrepreneur, a dentist, and director of the South African Dental Association, as well as the first YDC president back in his younger days. In this lecture, he will highlight common sense financial ideas that allow for seamless navigation from drilling to billing in private practice. Before I hand over to Dr. Mansoor, we can run through a few of the house rules. So please refrain from using the raised hand function, but rather type your questions in the Q&A tab below. Tonight's webinar will be eligible to earn 1 ethical CEU. And please join us for the final webinar in the series tomorrow evening, entitled Dental Tips No University Will Teach You, with our YDC panel as well as our senior dentists panel. All right, it seems we are on just over 130 people. Over to you, Dr. Mansoor.
Thank you, Tanisha, and thank you for the warm introduction. Before we start, I just want to compliment you and SADA and the whole YDC team for the 6-part series. I mean, I wish we had initiatives like this when we were a young dentist. Not that I think we feel much older, but when we were starting out, this would have really allowed us to not pay school fees unnecessarily. So I'm hoping that my lecture today can kind of bring in some of the concepts on a more higher level, on a more strategic level, to that what you guys have been discussing in the past week. So with that, I'm going to just try and share my screen. You're going to guide me on this.
Sure.
Okay, can you see my screen?
Yes.
Cool stuff. Does that look good?
Yeah, all good.
Okay, wonderful. So good evening, colleagues. It's a pleasure to take part in these initiatives where it's kind of us giving back. With that being said, we still learn every day, irrespective of where we are in our career. My task tonight is to enlighten you guys on the topic from drilling to billing, or from drill to bill, navigating dental practice finances through data-driven insights. So what you guys can expect this evening, I'm going to touch on 3 things that you need to know, on 3 key concepts and 3 important SADA initiatives. So these 9 things, if you look at them from a holistic view, it should give a bit more insight and impetus to the other lectures that have gone on in the last couple of days in the series. So the first thing that we need to know on a higher level is to know the goal. And by that I mean, we need to understand the difference between an investment and a return on investment. The thing that we need to realize is that when we invest in our practices, we are making an investment. So if you look at the Investopedia definition of an investment, It's an asset or an item acquired with the goal of generating income or appreciation over time. So an investment could be the investment in your practice. It could be an investment in assets, in gold, in property, in shares, in Bitcoin, provided the goal is to generate an income and to appreciate over time. Now, whilst that's the notion and that's what's the ideal, assets don't necessarily generate income. Some assets can lose us money. When we talk about the term investment here, I'm specifically talking about investment in your practice. If you make the decision to go into private practice, you are making an investment decision. And when you make an investment decision, the way to measure whether that investment is worth your while or not is to look at the return on investment. So return on investment is basically a popular profitability metric used to evaluate how well an investment has performed. Sometimes investment performs negatively, sometimes it performs positively. In our practices, you'll see over your career that there'll be years where you perform positive, there'll be years where you perform negative. And there's years where you'll break even. The idea behind today's webinar is to make you aware of these concepts so you can use these data and drive strategy in your practices, knowing what the end game is, what the goal is. So this is just to highlight the difference between an investment and return on investment. So if you look at ROI, which ultimately stands for return on investment, it's a metric that takes your net profit over what you've spent on your asset, and you times it by 100. That gives you your return on investment. So if we use this in a scenario of Dr. Roots. So Dr. Roots is a post-community service dentist, and he invests R1 million to set up his new dental practice by the name of Sweet Tooth Dental Studio. His startup capital comprises savings from his community service earnings, a soft loan from his parents, and some borrowings. At the end of his first practicing year as a private practitioner, his financial statement reflects a profit after tax of 100,000. So my question to you is, given the slide that I showed you before on how to work out a return on investment, what do you think Dr. Root's return of investment is in his first year? If you can quickly put your answer in the Q&A tab, it'll allow me to gauge whether you're understanding this concept or not. And if not, we'll kind of unpack it further. So the Q&A tab is at the bottom. If you can quickly populate the Q&A tab, just to give me a sense of you understanding how return on investment works. Okay, so while you guys are doing that, I'm going to go on to the next know of what you need to know, which is know the game. Okay, I just squeezed the Q&A and most anonymous attendees are coming to 10%, which is 100% correct. $1 million on investment returning 100,000 after a year after tax will give you a 10% return on investment. So you guys understand the concept of return on investment. Excellent. Okay, the next concept that I want you guys to understand is the concept of inflation. So I found a very nice video that understands the concept that will make us understand the concept of inflation. So as we go through the presentation, there's a few concepts that I want to share with you guys, and I'll show you at the end how it all ties in and why we need to be aware of these concepts to make better decisions for our practices on a year-to-year basis.
Sign selling a Corvette for $1,000? Boy, would it have been sweet to live in that time, right? Actually, because of inflation, it would be pretty much the same. Inflation is the overall rise in prices of goods and services in an economy. Here's Claire. Claire heads over to the corner store to buy a pack of gum. That pack of gum costs Claire $1. Fast forward a year and Claire heads to the exact same corner store and buys the exact same pack of gum. This time though, the pack of gum costs Claire $1.02. That 2% rise in the price of the gum is inflation. Inflation causes 2% rise in the price of the gum is inflation. Inflation causes a rise in prices and also causes the value of your money, known as purchasing power, to decrease. Claire's $1 is worth less today than it did last year. In general, the demand for goods and services in an economy is greater than the supply, causing prices to rise and therefore inflation. Governments can control the inflation rate by adjusting the supply of money in the economy. Developed countries like the US try to keep inflation around 3%. Because your money decreases in value every year, it's important to grow your savings through investment.
Okay, guys, so that's the concept of inflation. Basically, the purchasing power of our money erodes every year depending on the rate of inflation. So if we go back to our case study of Dr. Root, Dr. Root's accountant, Mr. Bean Counter, casually indicated over a cup of coffee that inflation averaged 6% for the financial year in question. So building on the first question, where you guys spot on worked out the return on investment, the question now is, did Dr. Root's practice investment beat inflation? So inflation averaged 6%, and you guys rightfully answered that his practice returned 10% to him. So clearly, the question is, did the practice investment beat inflation? 10% return, 6% inflation. The answer would be yes. His practice investment beat inflation by 4%. So ultimately, he was 4% better off the next year if you look at the purchasing power and how inflation had eroded investment income. He was 4% better off. So the first no is to know the goal. What are we aiming for? What return are we aiming for? The next no is to know the game. What are we fighting against? The next, within know the game, the next concept I want to introduce you to is something called opportunity cost. So we've got to know the goal. Within the game, we've got to know how inflation works, and we've got to understand the concept of opportunity cost. And this video will explain to you quite nicely what opportunity cost means.
Is what a person sacrifices when they choose one option over another. Tony is a sous chef at one of the best restaurants in the city. He earns a respectable salary of $50,000 a year. It's a good job, but he thinks he can do better. So he decides to start his own restaurant called Tony's Bistro. In the first year, he earns only 25% of what he made as a sous chef, or $12,500. The opportunity cost of starting his own business is the other 75% of the income that he would have made if he had stayed at his old job, or $37,500. Tony doesn't make too much for the first 4 years his restaurant is open, and his opportunity costs are high. He only earns $50,000 instead of the $200,000 he would have earned at his old job. So his opportunity cost is $150,000. Suddenly, in year 5, Tony's Bistro starts receiving rave reviews from food critics and earning top rankings from Zagat and Michelin. Business is booming, and he is making 5 times as much as he made at his old job, or $250,000 a year. He realizes that if he was still working as a sous chef, his opportunity cost would now be $200,000 a year. Although Tony sacrificed income and his opportunity cost was high in the short term, in the long run, his opportunity cost would have been higher if he had not opened his own restaurant.
Okay, guys, so basically opportunity cost is the decision we make, what we're giving up now for something else. So simple example is, if we have a decision to make an investment decision in our practice of purchasing an intraoral scanner or a PanSEF. An intraoral scanner will bring a certain amount of return, or a PanSEF machine will bring a certain amount of return. Some of us may be lucky enough to be able to afford both, but in most cases, we have to choose what's better for our practice and what will bring in a better return. So if we choose the intraoral scanner, our opportunity cost is that we chose the intraoral scanner as opposed to a PanSEF machine, or a microscope over a CBCT, or do-it-yourself dentistry, making our own crowns or sending it to the lab. So if you make your own crowns, it takes more time. But if you send to the lab, it may be more expensive. And we've got to work out which is the better option for us in our practice. Or we may look at dentistry and what is returning. If you guys feel 10% is a reasonable return, but a Pedro's chicken might give us a 15% return, that 5% is our opportunity cost. We chose dentistry for 10% over a Pedro's or a Nando's or a Chicken Licken that could have given us 15 or 20%, and that difference is our opportunity cost. So everything we have to do has to do with decision making, and decision making can only be tied in to the information we have at our disposal at that point in time. So every decision has a reciprocal decision, which is opportunity cost. And that's the second concept that I want to introduce you to within knowing how to play the game. So building on our case study, Mr. Bean Counter advised that investment returns averaged 8, 10, and 12% for fixed deposits, bonds, and stocks respectively. So what was Dr. Root's financial opportunity cost? The fact that he decided to take his money and invest it in his practice that gave him a 10% return, he would have got an 8% return if he had put the money in the bank. He would have got a 10% return if he had put the money in bonds, or a 12% return if he put the money in stocks. So on the face of it, his opportunity cost is 2%. He could have earned 2% more by putting his money in the stock market. But that's not where it stops. This is the most kind of simplified way to look at it. Then we go further to say, okay, if he lost out on 2% by not investing in the stock market and investing in his practice, is there anything else that could have benefited him where he took a short-term knock and played a longer game? So if you remember Dr. Root, this is his first year in practice, and his first year returned him 10%. His second year may return him 15 or 20%. His third year may return him even more. It's a new practice. So he would have made the decision of accepting 10% in the short term as opposed to 12% in the stock market, with the view that his practice will grow and give him a better return over time. But the idea of this analogy is to show you that whatever we're returning, so if you look at knowing the goal, and the goal is 10%, we got to look at the 10% relative to what other investments are giving us and whether that's a reasonable goal. And once we settle on the goal, we got to know how to play the game. What is inflation? Because we constantly need to beat inflation. If we don't, we're going to become poorer in time. And every investment decision, are we taking opportunity cost into account? Are we looking at one investment over another in our practice to say this would give us the best return for this procedure, which ultimately will give us the best return on investment, which should grow year on year, because this is where you put in your own sweat, effort, blood and tears into your practice, as opposed to putting money on the stock market and hoping for the best, or putting money in the bank and seemingly thinking it's risk-free. We all know banks fold. Or putting money in bonds and thinking it's the safest investment because government-backed. We all know most governments in the world are broke. So it's a decision. Where do we put our money? Where's our money the safest? And wherever we put our money, where can it give us the best return on investment? The third concept that I want to introduce to you under the know the game is the exchange of value, the two-way exchange of value. So in a practice, you've got the value to the business and you've got the value to the customer. And ultimately, the sweet spot is when your customer feels that they've got value from you for the service that you rendered, and you feel that you were reimbursed adequately for the risk that you've taken to set up your practice to achieve a certain return on investment, and for the satisfaction of providing a service where we've studied for so many years, and knowing that you've done good work. That's kind of where we need to pitch. Now, it doesn't work out so neatly all the time, but with our own efforts, we can come as close as possible to finding the sweet spot where you've got an awesome customer, and the awesome customer gives your awesome work amazing reviews. So if the sweet spot is tipped too much to the customer, it comes at the expense of the practice. If it's tipped too much towards the business, it comes at the expense of the customer. So in every procedure that we do, we've got to look at whether that procedure is falling within the business sweet spot or the value exchange sweet spot, where it's a win-win for all parties concerned. Once we've come to that comfort zone, then we've got to see financially whether that procedure is financially viable, whether on a procedure to procedure basis it's leading towards achieving our return on investment goal. Because if it's not achieving our return on investment goal, we may have an opportunity cost loss. There may be other investments where we could have put our money in rather than starting up a practice of our own. So the exchange of value is at the most basic level of interaction between you and your practice and your patient. Then the third concept is obviously to know your worth. So the first know is to know the goal. The second know is to know the game, how to play the game, understand inflation, understand opportunity cost, understand exchange of value. And the third know is to know your worth. So taking into account the various topics over the last week, I just want to touch quickly on third-party funders. And I thought this was a nice video by the People's Princess that kind of puts the point that I'm trying to make into perspective.
It's a bit crowded.
So in the video, it was the famous interview that she did in the late 90s. And she spoke about her being part of a three-way relationship, and it was a bit crowded. And the feeling is that when you engage with third-party funders, it's a bit crowded. The slide before this, I mean, we saw that any exchange of value is between two parties, and that's where you get the sweet spot. Once you introduce a third party into it, it becomes a bit crowded. So if we look at three scenarios, in your practice, if you do good work, and the patient pays you extra, which hardly happens. I don't think it's ever happened to me. But just as a hypothetical example, if patients pay you more than what you did, I mean, if you go to a restaurant, you give the waiter a tip. Even if you book an Uber, there's an option to give the driver a tip. I'm not saying that we should advocate patients giving us a tip, but in the hypothetical example that a patient paid us more than what we had billed, then I would regard that as a gift. The patients, I mean, for our awesome service, they may feel that we undervalued what we gave them, and they pay us a bit more, and that's a gift. But if we do work for patients, but if we don't do work for patients and the medical aid pays us, that's regarded as fraud. But in most cases, we do work for the patient and the medical aid underpays us. And we can ask any practitioner in the country, it's not the fees that they pay us, but in most cases, claims come back short paid because the patient doesn't have funds. And for me, that's just sinful. And these are the dynamics in a relationship where there's a third party, and especially third party funders. The landscape of fairness from my experience is not there. So I just want you to take this into account, given all the previous webinars that you've listened to about third party funders. Not to say not to deal with them, but know how to deal with them as knowing your worth, as part of playing the game, in the hope of achieving a goal that's relative to other investments out there. So given these concepts and these scenarios, there's a golden opportunity that's on the table and that's ahead of us, and that we all need to latch onto, we all need to grab onto if we want to create that successful practice that we aspire for. So I'm going to touch on three things that SADA is busy doing amongst the many things that SADA is doing, and why these three things are important for us to get involved, for us to understand, and for us and for it to help us put into perspective how to achieve our goal. So SADA embarked on something called an RVU study a few years ago. It took about 3 years to complete, a very intensive process where we went throughout the country. We had hundreds and hundreds of dentists involved. And ultimately, the RVU stands for Relative Value Unit. And it's a means of measuring the complexity of dental procedures in terms of the experience, judgment, skill, and effort, as well as the time taken. And this was a study that was done with Deloitte. And we released it, I think, about 2 years ago. But it was critical for us to have done this study because whenever SADA negotiates with medical schemes on behalf of the profession, the first thing they ask for is the industry's RVU study to obviously compare with their RVU studies. Now, their RVU studies are probably taken from other associations throughout the world. The SADA RVU study is a proudly South African study. It was done with South African information, with South African data by South African dentists, with us all giving feedback on how we measure skill, effort, risk, experience, and judgment. So if you've got some time, go onto the SADA website, find the June 2021 Volume 76 SADA Dental Journal, and read up about SADA's initiative in the RVU space, because the RVU is essentially our ticket to the game. Then SADA also developed a wonderful tool called the Decalc. The Decalc is an Excel-based tool that assists dental practitioners to understand the impact of practice cost and productivity on pricing. So these SADA initiatives are going into the rands and cents of it. Think of these initiatives in light of knowing your goal, knowing the game, and knowing your worth. Because ultimately, these things allow you to put a tangible value on what you're doing. So the Decalc will guide us on profitability in individual practices and under various scenarios. That's important because profitability directly ties in with return on investment. And return on investment will allow you to compare with other investments out there. So it'll allow you to make better investment decisions, knowing your opportunity cost. That's how important the Decalc is. It's based on a recognized cost accounting approach known as activity-based costing. It allows practitioners a better understanding of their practice. A lot of effort has gone into the Decalc. A lot of resources and money was spent in developing it. So I can only encourage you to look at the link at the bottom of the slide and try and order your Decalc through SADA and start playing around with this tool. It's the best tool that I've come across that gives you insight into the return on investment. So that's the SADA Decalc. And then SADA is lobbying on the concept of balance billing. The Health Professional Council, which regulates the dental profession, permits practitioners to balance bill their patients. Now, previous speakers would have touched on balance billing and split billing and what's legal and what's illegal. Balance billing is legal. Balance billing means if you charge 200 Rand for a procedure and the third-party funder rate is 150 Rand, you charge the patient 50 Rand, the 50 Rand different. That's legal. You go to a pharmacy, most pharmacies you go to, they're going to say, Dr. So-and-so, there's a co-payment and we willingly pay the co-payment and walk out smiling. In dentistry, the schemes have built their reimbursements in such a way where they've created a negative incentive for us not to balance bill, for us to accept their tariffs. Now, I'm not saying we mustn't accept their tariffs. And if anyone says we mustn't accept medical aid tariffs, it's out of context. If you feel that the tariff the medical aid is willing to reimburse you makes sense in your return on investment scenario, taking into account your opportunity cost, and if it makes sense for you, then by all means, that reimbursement is fair in your scenario. But if you use the Decalc and you work out that their reimbursement is short of you achieving your return on investment target, then you have every right to balance bill the patient. It is legal. You cannot be held responsible for doing anything illegal. So if you can make some time and go to the SADA Dental Journal, volume 76, April 2021, there's a wonderful article. And around the time this article was published, SADA went on a bit of a media campaign, a public relations campaign to make the consumer aware that if your dentist is asking you for the co-payment, he's not asking you anything illegal. It's within his right to ask you for a co-payment because that makes sense for his practice scenario. So the three things that SADA is currently working on, amongst all the other things, is the RVU study to get it accepted by medical aids, the Decalc, which is already a tool that's available, and lobbying for balanced billing. This should allow practices that are not surviving on medical aid tariffs to be able to understand the reimbursement that their individual practice needs scientifically. So if anyone challenges you, you can show them that this is how you've worked out and it's perfectly legal. So those are the three initiatives from SADA's perspective. Okay, so let's recap what we've been talking about for the last 30 minutes. There are three things I shared with you that you need to know. You need to know the goal. You got to start with the end in mind. You got to know what you're working towards. You got to know the game. You got to know how to play the game. Business is a game. Practice is a game. The better you understand the rules of the game, the better your chances of success. In knowing the game, we have to understand how inflation erodes our purchasing power and erodes our income. We need to understand how opportunity costs, what decisions we have to take into, or what we have to take into account to make the right decisions. So our opportunity cost is positive, and we have to know our exchange of value. That when we're engaging with our patient, that it's fair for the patient and it's fair for the practice. Both parties must leave the appointment with a win-win scenario. Patient must be happy that they got value for what they came for, and you must be happy that you got value for what you've studied for. Then the three key concepts and the three SADA initiatives. These 9 things together, right, will give you a reasonable understanding of how data-driven insights would drive your decision-making. So at the end of the year, you and your accountant need to sit with your financial statement once it's finalized, just like Dr. Root did in knowing that he made a 10% return on his investment. You've got to analyze your financial statement. The process of analyzing, and that's the process of analyzing a company's financial statement for decision making. If at the end of year 1, we don't analyze and we don't understand why certain things happened, we're not setting ourselves up for success in the second financial year or the third financial year or the fourth financial year. And I've seen many colleagues that have been in practice for 20, 30 years, they retire broke because every year just spun into the next, and they were not making decisions with proper data. And they're not changing what they were doing to make their practices better. In the last 30 minutes, I've been presenting to you tools that will help you to make these decisions. SADA has tools available that will help you to make these decisions. If we don't analyze on a yearly basis, on a monthly basis, how our practice is performing, by the time we realize we're going broke, we're going broke, it's too late. So we've got to be on top of the numbers. We've got to be on top of the information for us to be able to make better decisions going forward. So good old common sense. What we've been speaking about is nothing out of the ordinary. It's not rocket science. It's literally good old common sense. To be successful in practice, you've got to know key aspects of the business of dentistry, which is the goal, the game, and the worth. You've got to invest in assets after thoroughly analyzing opportunity cost scenarios. Do I buy a 3D printer or do I buy a laser? Do I buy a CBCT or do I buy a CEREC machine? Do I go into a practice or do I buy a filling station or do I buy an endos or do I go into any other business? if you make the decision to go into practice and you're comfortable and you've done your numbers and you've done your research and you've done your scenarios, then whatever assets you invest in, you've got to sweat your assets because you've got to understand inflationary pressures and exchange of value. And if you can get these things right, and it's not gonna be right all the time. You're gonna make mistakes. Mistakes are part of learning. It's part of life. We've all paid school fees. But the idea is to make less and less mistakes as you progress through your career. You'll then come to a zone of comfort or a comfort zone where it's working, you're in flow, your practice is running. You just got to repeat the process. So the diagram on the right I borrowed from the book Rich Dad, Poor Dad, where he talks about how the poor invest in assets, how the middle class invest in assets, and how the rich invest in assets. If we look at dentistry and dentists, if we look at how kind of inverted commas poor dentists invest, the practice makes an income, everything goes into expenses, and at the end of the financial year, there's no profit or there's a loss because they've kind of stripped all the income out of the practice. These are dentists that don't invest in their practices. They strip out all the income and they use that as their for their personal drawings and personal expenses. Those practitioners ultimately end up poor in the middle of their career, at the end of their career. And I've personally seen colleagues in this position. Then you get most dentists are in the middle class kind of band of dentists, where the practice makes money, they pay the expenses, they invest in assets, but they invest in assets that don't add to the top line. They invest in assets because it makes them feel good. They can show off to their friends and colleagues about the toys that they have, but those toys are not really bringing money into the practice. It may bring some money, but not enough to be able to make the repayments, to be able to justify the additional insurance and all of those type of things. And those assets are ultimately liabilities. If you look at point 3 of good old common sense, the rich dentist, the successful dentist, they sweat their assets. Sweating their assets means it's in use all the time. If you look at an aeroplane, if an aeroplane is grounded, it's losing money. It's only sweating. The asset is only being sweat if it's in the air. And it's only being sweat in the air if most or all the seats are sold. If the plane's on the ground, it's a liability, it's a dud. And most dentists that I've seen fall into this middle class scenario, where we buy things to make ourselves feel better, to put it on our website, on our social media, and think that patients appreciate that we've got the latest toys. Patients don't necessarily appreciate that. But what they do appreciate is if we can use those toys to enhance their experience in the chair and find the sweet spot in the value exchange. That's what they experience. So we should be investing in assets that's going to allow us to achieve that. Then there's a few rich and successful dentists that I've encountered. And these are the other guys that grow their income. With their income, they buy the right assets, the assets that they can sweat, the assets that's used most of the time in their practice. And those assets generate more income than the repayment and the insurance cost and the depreciation that it incurs. Then that income goes back onto the top line. And with that income going back into the top line, they can invest in more assets that do the same thing, and they hit the repeat button. So the rich dentists, the successful dentists, the dentists that are in flow, the dentists that have analyzed their financials on a yearly basis, they've made decisions based on their numbers. They know what's happening on a month-to-month basis. They know the type of dentistry to promote. They know the type of patients to look for. They can match the investment with their skill and the patients that appreciate their skill. Those are the guys that really come home at the end of the day with a heart that's been fulfilled throughout the day with the work that they've done. And unfortunately, I've seen very few of these dentists in the country. There are a handful of them. They're there. They show us that it's possible to achieve that. But unfortunately, I've personally seen very few of our colleagues in that position. Most of us are in the middle class, and some of us, unfortunately, are on the poor spectrum. And I'm hoping that the insights that I've shared with you tonight will allow us to move towards the right, towards the successful part of practice, because that's what makes it worth it. So my topic was I'm drilled to build navigating dental practice finances through data-driven insights. And then I'm hoping from a kind of a philosophical point of view, from a business point of view, I've shared with you learnings that I've learned the hard way, and I've implemented in my business. And I hope that you can just go, just understand these the 3, the 9 concepts that we've spoken about, and how you can incorporate that into your decision making to ultimately navigate your dental practice finance through the data and the insights that it's providing to you. So without further ado, Tanisha, I'm willing to take some questions if there are any. Thank you so much.
Thank you so much, Dr. Mansoor. I think I learned a few things as well there, even after being in practice for 10 to 15 years. I definitely learned some new things. So it's most definitely not for, I think the information that you presented is not only for dentists that are starting out or in terms of mentorship, but really for anyone in practice that's easy to understand and easy to apply. So have a question in place here. With regards to balance billing, is the co-payment for the patient done at the end of the appointment before the bill is sent to the medical aid? Thus, before knowing the exact amount the medical aid is willing to reimburse? Or is the co-payment sent to the patient after knowing the exact amount that the medical aid paid to you as the dentist?
Okay. So what you would do is, if the procedure has come to 1,000 Rand, whatever you've done, you would submit the claim to the medical aid. If you know upfront what the medical aid is going to pay for, or what the rate is, most billing system has the medical aid tariffs loaded on. So if there's a difference, the invoice should generate the difference. Then the patient pays before they leave the appointment, because you know what the medical aid rate is. Once the claim is submitted and there's a short payment on the medical aid rate, the patient would have to pay the difference. Sometimes you would submit a claim not knowing what the medical aid rate is, but in most cases we should, because most practice management systems have the rates loaded. Then you would send the patient the bill afterwards to say, this is a short payment and this is what you need to pay. The best scenario is that your practice management system is able to separate what the medical aid tariff is and what the difference is, and the patient pays the difference before they leave the practice. That's the scenario that we work towards in our practice, and most management systems have that function.
Okay, thank you for that. I think if the anonymous attendee who asked this question, I think if you remember back to some of the previous webinars, it was also mentioned where it is permissible for you to actually make use of columns when drawing up your account, and your first column will then reflect the amount that the medical aid is going to pay, and your second column will then reflect the balance, and your last column will then reflect the total. And that is completely legal for you to do. And in terms of knowing how much the medical aid is willing to pay for procedures, I think that's fairly easy. If you go onto the SADA website, we have a whole host of different schemes, managed care companies, all of their billing, their billing information, their tariff guides, as well as their rates. So that will be easy enough for you to be able to populate that.
Yeah.
Another question that is,
so yes? I think what we should highlight here is that you can't give the patient one bill and the medical aid one bill. So it has to be on the same bill. So the patient gets the same bill the medical aid gets, right? And the patient pays the difference that the medical aid tariff won't cover.
Correct. The next question asks, how would one properly investigate the opportunity cost scenarios? What would be the process? For example, deciding between buying different equipment or assets.
Yeah. So this is something that's subjective, right? You're going to have to put pen to paper. You're going to have to look at the pros and cons of each equipment. You're going to look at what that equipment can generate. So if you buy a laser machine over a microscope, what can you charge for the laser procedures? What can you charge for the microscope? What's the scope of work that can be done with lasers? What's the scope of work that can be done with microscope? What's the repayments on each? What's the insurance on each? Right. And then you would then use a Decalc to work out what you should be charging for the procedure. And whichever one's giving you the better return, financially, that's the better investment decision to make. But then also professionally, what work do you prefer? You may be a practitioner that prefers to do only endodontics, and you want a microscope, and the laser comes next. Or you might be someone that loves to do laser work, and the microscope is kind of a nice to have. So you got to look at your own personal scenario. What's going to make practice better for you? Once you understand that, which of it will give you a better return? Sometimes you'll be willing to give up the better return because one asset makes practice better for you. That's a personal decision. But whatever decision we make, we've got to understand that inflation is reality. Inflation erodes purchasing power. So if our return on investment is not beating inflation, we are going to end up in the poor category of dentists. I can bet money on that. That's how guaranteed it is. So we always got to make our decisions fulfilling our personal needs and wants, right? Because that's what makes getting up in the morning and going to work fun and exciting and interesting. But work is not only about being fun, exciting, and interesting, because if that's the way we look at it and we don't look at the financial element, we're not going to have more opportunities of having fun because our practice won't exist. We won't be able to run it sustainably. So there's a fine line between what makes us happy and what's going to keep us sustainable. And the message I've tried to drive home is whatever decision we make, whatever personal decision we make, try and make it in a way that's going to give you the best opportunity to beat inflation and give you the best return on investment that you can achieve.
Thank you so much for that answer. Another question by an anonymous attendee. Will Discovery pay such a bill showing the additional amount due by a patient? Discovery usually pays to the patient whenever the tariff is higher.
Yeah,
I think we all know the answer to this one.
When I mentioned earlier, and I used the People's Princess as an example, whenever there's a third party, it's crowded, right? Whether it's Discovery or anybody else, Discovery is just a third party funder like everybody else, right? Some third parties are smarter. Some know how to create negative incentives or disincentives, right? By paying the patient, it's a disincentive for us to charge the co-payment, right? If we don't charge the co-payment, the third party can market that practices don't charge co-payments as a selling point. That's irrespective. The bottom line is the tariff that the third party reasonable for you to achieve your goal, your financial goal? If it's not, you've got to charge a co-payment. There's no rocket science behind it. You're going to grow broke. When you're starting off in practice, you may not have expenses from a personal level or any other level, but as you progress in your career and as your family grows and everything grows, you need to be earning more. So you may start off accepting third-party tariffs, and that may be phenomenal, that may be wonderful. But as you progress in life, you realize that that's not enough to allow you to just live life, and you have to then start introducing co-payments. So we've got to be smarter than the people that disincentivize us. They usually do pay the patient, and it's a clever way of disincentivizing us. We shouldn't fall for that trick. If we know through our Decalc what we should be charging for the procedure, we must be willing to forego a patient that's not willing to appreciate the work that we are able to do. And that's where the exchange of value comes in. That's the sweet spot. The patient must be happy and we must be happy. When you have a patient in a scenario that's win-win, they will gladly pay the co-payment, or they will gladly pay the bill upfront and claim it from the medical aid, or they will pay the co-payment, the medical aid pays them and they will pay you. So we've got to work out the dynamic of the practice. But whatever it is, every scheme will have their own disincentives because they want to keep healthcare costs as low as possible. It's very noble to want to keep costs as low as possible. We all want to keep costs as low as possible. But in this day and age, it's not practical to keep costs as low as possible. Ask anybody in any practice, all our costs have gone up. the exchange rate has tanked, things have gone up, inflation is high, everything has gone more expensive. But have we got more money? No, we haven't. So the only way for us to beat inflation is to start charging co-payments. There's no other way. If we're going to stick to the tariff and inflation has peaked this year and things have gone up, how are we funding that difference of cost in our practice? We are funding it at our own expense. We are taking salary knocks and we are dropping our income to overcome the increased cost. That's not how it should be done. When costs go up, costs should be pushed to the consumer. When petrol prices go up, we pay more at the pumps. When grocery prices go up, we pay more at the grocers. Right? That's how it works. Why do dentists absorb it to their own detriment? It's time that we stand up and I mean, SADA is doing all of this work. There's wonderful work that's being done. But as an industry, I think we need to create more impetus behind it so that we can lead the change that we want. If we don't, the schemes will continuously be the crowded party in the scenario, and take advantage of us. I feel that we are constantly being taken advantage of.
Yeah, I think that's a very fair point that you make there, and I think just on your previous point with regard to normal inflation, is it not the case where medical inflation or healthcare inflation is even at a higher rate than normal inflation, and that already puts a lot of additional pressure on the healthcare practitioner, and is something that must be taken into account. Yeah,
but you see, when we talk about healthcare inflation, we get roped into the basket of healthcare inflation. But if you look at 100% of the market, we'll probably account for 2%. So where's the healthcare inflation coming from? It's not coming from us. It's probably coming from the pharmaceuticals or the hospital groups or the specialist groups. We don't know. We have to look at the stats, right? But it's definitely not coming from dentists. So to group us under healthcare inflation is wrong. It's not giving the right signals. Dentists are not the ones that are initiating healthcare inflation. And on the flip side, we are on the deflation side. If you look at 20 years ago, how much dentistry accounted for the basket of healthcare and what it accounts for now, we've dropped over the years. So we can't be the scapegoat for healthcare inflation. We have to find a way to keep us relevant and keep us sustainable. And the only way to do it is either the schemes pay us what we worth, or we charge the patient the co-payment to get to the level of what we worth. But there's no other way for us to do it. We have to do it, or else we're going to grow broke. It's guaranteed.
Yeah, unfortunately, it is, and that's why I sincerely hope that as many practitioners as possible start using the Decalc and start to calculate what tariffs you should be charging, taking into account your personal productivity as well as your personal practice incomes and expenses to help use the RVUs and calculate a rate. And in the Decalc, you see that they ask you for a return on investment, what your envisioned return on investment is. And now, thanks to this webinar, you actually know how to calculate that return on investment.
So the envisioned return on investment that the Decalc speaks about is knowing your goal. Upfront, you got to know, hey, this is what I'm aiming for. And then you got to reverse engineer it. Because if I don't achieve this target, then my opportunity cost there's a loss to me, because I could have put the money in the bank and sat back and got an income without the risk and the pressure of running a practice, running a business, engaging with medical aids, engaging with staff. You can do it in a more risk-free way by just putting the money in the bank. So these are the decisions. So if you're taking risk in your business, and if the stock market is giving you 12% or 14% or 15%, your practice should give you a much higher return. It should give you 20%, 25%, because you got to price your risk. If you apply for a home loan, your home loan rate may be different to mine, because they're going to price your risk and my risk differently, right? I may pay more, you may pay less, or you may pay more, I may pay less, because they may see me as more risky than you, or you more risky than me. They price risk. We're not pricing our risk. We are taking our R1 million hard-earned money that we worked hard in com service, that our parents lent us, that we borrowed from the bank, to invest it in a venture in good faith that we are going to run a profitable business, make good on the studies that we've studied all those years to become dentists. But that's not all. it's got to make good. You got to do good for yourself, but your business has to do good financially, because if it doesn't, then others can do better for you financially, and you rather put your R1,000,000 elsewhere, right? But we didn't study to become a dentist to put our R1,000,000 elsewhere. We studied to become a dentist so we can practice dentistry, make a profit, and be sustainable. But the point I'm making is that we've got to make our profit that takes into account our risk. And if we don't, then we're being foolish in the game. We don't know the game. And I hope the webinar tonight highlighted how to play the game in a sense. It's not just about knowing how to do a crown, knowing how to do a root canal. You've got to know that, and you've got to know how to run the business. So as dentists, there's a lot on our shoulders. We run a clinical part of our practice and a business part of our business, and they both are so interwoven, interrelated, that if we don't have our eye on both sides may slip. So it's not easy, but once you're in flow and once you're comfortable with how things run, then it's fun. Then you enjoy it. Then you know what to do. And that's what I'm hoping that I've highlighted, is that it takes much more, but we've got to keep analyzing and asking questions and asking why to come to answers, right? That will ultimately allow us to navigate our practice finances through the data-driven insights.
Thank you so much, Dr. Mansoor. I think we have all learned a lot. I think you've given us some really valuable insights to go home and think about. And yet again, I encourage all our members, go buy the Decalc. It's only 500 Rand if you're a SADA member, excluding VAT. And it really is something that will benefit you, help you calculate how much your procedures should be priced at, as opposed to, using medical aid tariffs as the go-to, because remember, those are not the go-to rates. Those have been, we have been underpaid for years. So calculate what your personal return on investment, what you envision that return on investment to be, and work backwards and calculate what you want to charge, what you see, and it ultimately comes down to what you feel that you are worth. So yeah, many thanks, Dr. Mansoor, and we look forward to seeing you in another webinar on SADA again soon.
Thanks, Tanisha. Thanks for having me.
Okay. Good evening.
Thank you, ladies.